Some more comments are going to be geared to the professionals to give them ideas and how the more exotic, shouldn't we call it exotic, but advanced tax planning techniques that impact charities or charities help. And on the nonprofit side, we're hoping to see how they can be aware of these techniques so that they can have better conversations with potential donors and know how some of these techniques benefit them or are less than attractive. Some of the ones that have the strongest tax benefits have the least benefit to the charity. So you just have to understand that from both perspectives. So with that in mind, Heath, do you know how to get the PowerPoint up? Oh, there it is. Okay. So title is giving techniques that maximize tax benefits for the donor and enhance the cause of the nonprofits in our community. So our community is the San Fernando and Santa Clarita Valleys, and we hope to address that audience in particular. A lot of our nonprofits on the call today are from the valleys. Okay, next slide. Okay, we've been told a little bit about who the Community Foundation of the Valleys is. We are associated also with the California Community Foundation. So they both have the word Community Foundation. One is a multi-billion-dollar foundation, and the other one is us, a small foundation that's trying to help the nonprofits in San Fernando and Santa Clarita Valleys. And part of our theme is to give local. So we want to talk to people who live in these valleys and encourage them to give in these valleys. And one of our strongest tools is the Donor Advised Fund. Go ahead, Keith. So if you don't know what a DAF is, probably the most important thing you can walk away from this conversation is to understand what they are. This is a very powerful tool, a donor advised fund. And it's a fund within that's sponsored by the Community Foundation of the Valleys. So you could make a gift to the Community Foundation in the form of a DAF, and then you later, over the next 10 years or whatever, tell the Community Foundation where to spend that money. So it's like accumulating an investment egg for nonprofits and setting it aside, and then as you see needs, dispersing for those needs. So on the nonprofit side, you need to be talking to people who have DAFs. They've already gotten the tax benefit from a charitable contribution, and now the money is sitting in the Community Foundation waiting to be spent on a nonprofit. And sometimes it'll just sit there forever because the person got their tax benefit and they aren't too excited to rush out and start dispersing it to nonprofits. So again, if you're a nonprofit, it'd be nice to find out who has a DAF, or in talking to potential donors, ask them if they have a DAF and encourage them to free up some of those funds for your nonprofit. So what is the real benefit of a DAF? Why are they so popular? Well, if you're in a high income tax bracket, it allows you to make a contribution to the DAF in the year that you have a lot of taxes and therefore get a huge tax benefit. So it's all about maximizing the tax benefit based on the year or years that you're paying the most taxes. So a very powerful technique. Silicon Valley gives tens of millions of dollars to DAFs in years when they're selling stocks, going public. And I'm sure there's billions and billions of dollars in DAFs today compared to 20 years ago when it was relatively unknown.
Hey, Bill, can I ask you a question? When would you use a DAF versus using, call it a private family foundation that so many of us are familiar with over the years?
That's the next slide. So just hold off for 1 minute. But before you go there, let me finish some of the points I want to make on that prior slide. We do use the California Community Foundation, the $1 billion foundation, to hold the funds for us. So they're our back office. And so when it's time to make a donation, you fill out something called a grant recommendation form, send it to the California Community Foundation, and they will disperse the funds. So it says donor advised, right? And first impression is, well, the donor can advise, but can he really dictate? And the answer is yes. Community Foundation will not do anything until you advise them on where it's to go. And as long as it's a 501c3 charity, they will disperse it there on your behalf, regardless of where it is. So don't be afraid of the word advised. You're in control. And while it sits there to be spent, the funds are invested, and so they're growing. And then the Community Foundation of the Valleys gets a 2% fee, which they share with the California Community Foundation. But that helps pay our expenses, our overhead. So we love advocating this because we can earn that 2% on the funds that are invested in the DAF and help support our operation. So it comes in very handy for us. Okay, next slide. Okay, so everybody knows about private foundations. Most are owned by families. Many of them have hundreds of millions of dollars in them. They're huge, including in Los Angeles. And I'm sure every nonprofit knows the private foundations that are in their community and ask for grants on a regular basis. It's very common. But let me make the argument that a DAF is better than a private foundation. So for wealthy people who have not yet set a private foundation, they should consider a DAF instead. Now, let's be clear. If we're talking $10 million or more, probably do a private foundation. But if we're talking about $1 million or $2 million, I would submit that a DAF is much more powerful and beneficial than a private foundation. So why do I say that? For these 6 reasons. No legal fees to set it up. It's expensive to set up a private foundation, maybe $8,000 in legal fees. You just open an account with our foundation. Bingo, done. Then there's no minimum annual distribution. This is probably the most powerful one. Those people in Silicon Valley who dumped tens of millions of dollars into DAFs love it because they don't have to think about dispersing it yet. They just let it sit there. And they got their tax benefit, and they're in no hurry to decide which charity is going to get the proceeds. There are no rules yet over that by the federal government, although we're going to talk about one proposed in a minute. There's no tax filings. A private foundation has to file a 990 PF. It's maybe 20 pages long, a lot of disclosures, financial information, and otherwise. A very rigorous document that is expensive to prepare. There's no tax return filing for a DAF. Private foundations have excise taxes based on their income, up to 2% per year. No excise taxes. No restrictions on activities. Private foundations, I guess back in 1969, I think it was, the federal government was afraid that people would do self-dealing and other things to get benefit out of a private foundation. And so there's a lot of restrictions that came down around 1969, I believe, on what a private foundation could do with the money. Certainly can't make a loan to the donor, and all sorts of other restrictions on activities. And lastly, there's no corporate compliance. So just like any other corporation, a private foundation has to have board meetings, registered with the state of California, pay certain fees to the state of California, none of that corporate compliance. But in the box at the bottom of the screen, you see legislation was proposed in this year, or I should say last year, to require that DAF assets be distributed to charities within 15 years. I thought it was pretty generous. No rush. Still no rush. But an interesting caveat or carve out. If the funds are with a community foundation, like the Community Foundation of the Valleys, there is no 15-year rule. as long as the balance in the DAF is less than $1 million. If it's more than $1 million, then yes, even then they have to distribute within 15 years. But I think that's a very generous distribution requirement. That legislation did not pass. We'll see if it's reproposed in 2022. It may or may not be. Congress feels that there's a lot of abuse in DAFs for the very reason I indicated. People get the charitable deduction and forget about spending it on charity. So now there may be more of a linkage. Next slide. Okay, now I'm going to dive into 4 techniques. Won't be the only techniques we talk about today, but it's an interesting progression from simple to complex. So we've already talked about transferring cash to a DAF. We're also going to talk about a little bit more complicated, transferring appreciated assets to a DAF. Even more complicated still, transfer of appreciated assets to a CRT. I'll define that for you in a minute. And 4, transferring appreciated assets to an LLC that is 99% owned by a CRT. Sounds a little complicated, it is, but we'll touch on it from a big picture point of view so you can understand the power of it and why it's something that professionals need to understand when they're advising their clients, but the nonprofits also need to understand it so they understand what these techniques are, and they may even be suggesting them to prospective donors themselves, saying, talk to your CPA about this. It may be useful in your situation. Okay, so let's go to the next slide. So way back in 2017, it's funny, Heath and I did this presentation in 2018, right after the 2017 Act changed. So this slide is from that presentation, but now it's 4 years old. But at the time, we were worried about the new standard deduction being bumped up to $25,000, whether that would cause people not to be as charitable. Because if they could get a standard deduction for $25,000, it's better. It might be better than itemizing. And of course, one of the itemized deductions is charitable contributions. So a lot of anxiety whether charitable contributions were going to go down once the standard deduction went up. But I'm happy to report that as far as my client base is concerned, and of course the nonprofits may have views on their own, I don't think charitable giving has gone down, at least not motivated by taxes. One good reason is the wealthy people who give a lot of charity are going to itemize and not take advantage of the standard deduction. So a couple of things in there that I don't want to go down each item in the list, but what is an RMD? Third item, required minimum distribution. That's from a retirement plan or an IRA. Once you're 72, 73, you have to start giving a certain minimum amount away. Taking a distribution from the plan to yourself and pay tax on it. So one of the techniques that has become very popular is that instead of taking the RMD and paying tax on it, you give that amount to charity and have it dispersed directly. You don't receive it and then disperse it. You make a direct transfer from the IRA to the charity and arrange that with who's ever the custodian of those funds. And so that is a great way to give up to $100,000 to charity without worrying about itemized deduction limits or standard deductions. It won't be taxed, but you won't get a charitable deduction. It's a wash, but it's an easy way to give to charity and make sure you get the full benefit. Well, the third up from the bottom, it says the maximum tax rate for federal plus California is 50%. I think it's good for every nonprofit to know that. So wealthy people, you get to 37% rate, about 500,000 of income. California will get you in the 13% bracket at a couple $1 million of income every year. So that rate doesn't apply until a little bit more income is earned. But everybody needs to understand, every nonprofit needs to understand that when they're talking to wealthy people who make a lot of money, that their taxes, they're in the 50% tax bracket. So if they give $1 million to your charity, they will save $500,000, subject to certain limitations. For example, the bottom one, 60% limit on cash donations as a percentage of your adjusted gross income. But that's an increase over what used to be 50%. So there are caps. You can't give away all your income, but you can give away 60% of your income every year. And if you do give away more than 60% in a particular year, the excess will carry over for the next 5 years. So a lot of speaking points there. Next slide. Okay, let's switch to appreciate assets now. I think the CPAs and the professionals on the call understand this, but I want to make sure the nonprofits understand it too. And giving an appreciated asset to a DAF instead of cash. And what's an appreciated asset? Let's say you have marketable securities. The stock market's been good to you this year. A couple of your tech stocks tripled in value, and now you're considering making a charitable contribution. Should you give cash, or should you actually gift the appreciated stock itself? And the answer is very easy. Give the appreciated stock, especially if it's materially appreciated. You get a double tax benefit. You not only save that 50% we just talked about, you don't have to pay capital gains tax on the appreciation. That's a double whammy benefit. And it works beautifully with a DAF because as a nonprofit, do you really want to be receiving appreciated securities and turning around and selling them? Isn't it better if the appreciated securities are given to the DAF and turned into cash probably 2 days later and then distributed to you? You don't have to mess with selling the securities. So a great tool. Encourage everyone to be using this a lot, both on the professional side and the nonprofit side. Incredibly powerful. And of course, it's not just appreciated marketable securities. It can apply to real estate. Again, not many nonprofits want to receive real estate, but a community foundation, especially with the California Community Foundation as our back office, is happy to receive real estate. They're going to turn around and sell it. So there better not be too many restrictions on the ability to sell it, but they're going to list it and sell it. And if it's materially appreciated, you get that same double tax benefit. And even closely held businesses may work. It's a little bit more difficult to deal with because the California Community Foundation doesn't want to own your business. But if you're about to sell your business and a month before you sell it, you give some of the stock to the DAF. Yeah, when it's sold a month later, it's turned into cash, and you get your double whammy benefit. So that's very powerful. So avoiding the capital gains tax could end up being I use in the fourth bullet here. I've got $1 million charitable gift to appreciated assets with a tax basis of $100,000. So there's a built-in capital gain of $900,000, very substantially appreciated. Okay, avoiding the capital gains tax on that $900,000 is probably at a 33%, if not slightly higher, tax rate. I've got federal of 20% plus California of 13%. Well, there's also the Medicare tax, not Medicare, we call it the Obamacare tax of 3.8%, call it 4%. So it's actually more than 33% combined. It's closer to 37% combined. And but 33% of 900,000 is 300,000. So you're saving 300,000 in capital gains avoidance, and you also have a gift of $1 million at a 50% tax bracket, which is saving 500,000. So instead of getting a 50% tax benefit for a cash gift, in this example, you're getting an 80% tax benefit for an appreciated asset gift. 80%. It's only the wealthy person who's parting with this asset is saving 80% of what they give away. They don't have to be that charitable. 20% is not a lot to them. And of course, from the charity's perspective, they're getting $1 million. So it works great. Let's go to the next slide. Okay, this is stepping up the game a little bit. Go back one. Yeah, there you go. CRT. So let's start by defining Go back one slide, 2 slides even. There we go. CRT. So I'm going to use that a lot. Charitable remainder trust. So it's a trust. We have to form a trust. We, the donor, have to form a trust. Costs some money to form a trust, and it's going to have a term of years that it's in existence. It has to file a tax return every year. Has to file a gift tax return in the first year. So we're getting complicated now. So why do we want to get complicated? Because the benefits can be phenomenal. By the way, some professionals don't use the term CRT. They use 2 other terms called CRAT or CRUT, CRAT or CRUT. Let's not go there. It's a little bit more advanced. I want to get across the key point. I don't want to get into nuances. So those are nuances. So what is a charitable remainder trust? Well, look, it has the word split interest. What does split interest vehicle mean? It means there's 2 components to it. There's an annuity component. So over a number of years, it's going to be an annuity paid out of that trust. That's one component. And then there's the remainder. What's ever left at the end of the term of years, in this case, is going to go to charity. And that annuity comes back to the donor. So the donor really didn't give away a huge asset. He's gained the annuity from that for maybe the rest of his life or her life. And then at the end of that term, it goes to charity. So if I'm a nonprofit, I'm a little deflated now because I don't get it until the person dies, or at least maybe 20 years later. So I can't get too excited about it, but it could be a lot of money. And of course, if you do talk to donors about CRTs, on average, somebody's going to die every year. So it could be beneficial. So what is this term of years? Well, again, this gets complicated. I want to make it more simple. Most of these that you see are for the rest of your life, and if it's husband and wife, it's a joint life. So for the rest of your joint life, you get the annuity, and when the second person dies, it goes to charity. But it can be a term of years, and the example I'm using here is a term of years. If it's a term of years, you cannot go longer than 20 years. So I'm assuming we go out as long as we can, just 20 years. And another constraint that the government has, the IRS, is that the present value of what goes to charity has to be at least 10% of the value of what you contributed. Okay, so that means the remainder interest has to have a present value of 10%. And if you flip that the other way, it means the value of the annuity is 90%. Okay, so another way of saying this is the donors are going to get 90% of what you contribute, and the charity is only going to get 10%. So it's not fantastic for the charity, but we haven't talked about the main reason to do it. The main reason to do it is because if you're about to sell your business or a real estate that's worth $10 million, so let's say you're selling your business for $10 million, or you're selling real estate for $10 million, and if a few weeks before you consummate the sale, before you have a letter of intent, maybe it's a few months, but it's getting close, and you need to move fast. And CRTs are most often set up, I'd say, within 30 days of a major transaction, because by having the trust, the CRT, own part of that stock or part of that real estate or all of it, that portion will not be taxed when you consummate the sale. So at the time that you sell the asset, the CRT will own either 100% of that asset or part of it, whatever part you contributed. And we're talking typically 10 million. I want to think big here. This is not for smaller transactions. And what a fantastic way for the seller to save taxes. That, let's stay with the CRT owning 100% of the asset. Let's say it's real estate. So $10 million of real estate is about to be sold. You get the CRT in there at the last minute, but before there's a letter of intent. And the gain, 100% of the gain, let's say it's a $9 million gain. $9 million of gain will never be taxed. That's the reason why you do it. Okay, so let's say it one more time. Again, when do you use a CRT? When you want to avoid a mega gain. And you can always some struggles trying to get it set up before it's too late. A lot of tax court cases where it was set up too late, so you got to be careful. But what a fantastic tool to eliminate the capital gain on this huge transaction. What did the donor have to give up in exchange? He had to give up a remainder interest that goes to charity at his or her death or in 20 years. And we design it so that the present value of that remainder interest is only 10% of the original value. So it's only worth $1 million. So the present value of 10 million is 1 million. And that's what, in real terms, you're giving away. It's what's worth today. It won't go to charity for 20 or 30 years, but today it's worth $1 million when you avoided tax on $10 million. That's the dramatic benefit of this thing. Okay.
Bill, I want to interrupt real quick. I thought
please.
I would monitor the chat because I'm screen sharing off of my computer as the host. I am not able to monitor the chat. Other than talking about setting out the presentations, I don't have a problem setting out my slides. I'll talk about that with Bill. Are there any other questions that anybody wants to stop and ask quickly?
Yeah, this is a good break point.
Because I'm going to jump into CRTs a little bit more during my portion too. So
right, and I want to set you up for that too.
Anybody else? Any questions? All right, Bill, go ahead. Okay.
So this page gets into computing the benefit that I just tried to describe. So I'm more conservative here. I'm transferring $1 million of appreciated assets with a tax basis of 100,000. So a built-in gain again of 900,000. And tax savings are that same 300,000 that we had when we were contributing appreciated assets directly to charity. But we don't have the huge charitable deduction benefit because the only charitable deduction we can get is for the present value of that remainder interest going to charity. In this case, we're trying to design the present value to only be 10%. We have some ability to design that. So we design that so it's only 10%, in this case, $100,000. So we're only getting a charitable deduction for 50% of 100,000. So this part of it isn't as attractive, but the trade-off is you're going to get the annuity for the rest of your life. And so when you compare the tax savings to what the present value is and what's going to go to charity, the tax savings are 3.5 times what you're giving away to charity in present value terms. 3.5 times. Mm. That is just phenomenal. I can't dramatize that enough. CRT is a very, very powerful tax planning tool in the right situation. Typically when you're about to sell your business or a massive piece of real estate. Very, very powerful. Charity is going to get much less than the tax savings. Again, if you're a charity, not as exciting, but if you're planning, let's make it good, something good for the charity. The charity, here's something that's often done. When you can set up the CRT and get tax benefit and everything, and you say, I'm going to name the charity later. There's no requirement to name the charity. So if I were a nonprofit, I'd want to find, I don't know how to do this, but I'd want to try and find out all the CRTs that are out there already in operation that have postponed the decision on which charity is going to get it. Wow, if I could only talk to some of these people. And when I say that the donor runs the trust, you don't have to have a third-party trustee. The donor who's getting all the benefit can also manage the trust for the rest of his life, including deciding which charity is going to get the gift. So if I'm a nonprofit, wow, I want to find out who these people are and reach out to them. And of course, the donor doesn't have to leave it all to one charity. There may be $10 million that are they're in the remainder interest, and multiple charities can have a shot at it. And if 4 charities have already been named and you get a hold of that person, you can become the 5th. So it's something to work on if there's a way. And of course, if the CRT's already been in existence for 10 years, or said another way, if the person's now 80 years old, all the more reason to rush in there and try and reach. I just don't know the magic of how to reach out to these people, but there might be a way. I haven't given much thought to it. Okay, and the next bullet talks about so I said earlier, if the present value of what the charity gets is 100,000, that means the present value of what the donor retains is 900,000. It's a reciprocal. So if for 20 years you're going to get 70,000, which is the example in this case, which is $1.4 million, the present value of $1.4 million at the frank end of that 20 years is 900,000. So it's you get to keep a lot of money, 90% in this case. Okay, last bullet just reminding us that this is a very complicated topic, and I've tried to make it simple so we understand the concept. And by the way, I have recommended CRTs to wealthy clients about ready to sell their business no fewer than 100 times. And I'd say 30% of the time they do it. 70% of the time it's either too late or they don't want to rely on an annuity for the rest of their lives. But it's an excellent talking point with every wealthy person who's about to sell their business or real estate. Next slide. Okay, here's where my slides overlap a little bit with Heath, so I don't want to say too much about this. I'll kind of set it up for Heath, but we can get even more complicated than I just described. And that is, take that CRT, but let's interpose a middleman. So instead of giving the money directly to the CRT, we transfer the funds to a new LLC that is 99% owned by the CRT. LLC is just like a partnership. So now we parked is a good word. We parked the appreciated assets still right before they're going to be sold into the LLC rather than directly in the CRT. Okay, so we got 2 layers instead of 1 layer. Why do that? It can be very powerful, and Heath is going to talk on it. But I just want to say a few more things before I turn it over to him. So I've got the term NIMCRUT. I love that, NIMCRUT. Okay, what does it stand for? Net income, makeup, charitable remainder, uni trust. It's a mouthful, but let's just say what it does. The first bullet describes it. The NIMCRUT limits the annuities to the lesser of net income of the trust or the annuity rate, say 7%. So when you contribute the assets to the trust almost immediately sells the appreciated asset and now has a bunch of cash, and they invest that in the stock market. And who oversees that? The donor. So every year it's throwing off income, right, from the stock market. And every year there's going to be an annuity taken out by the donor. And if the net income for that year earned in the stock market is less than the annuity rate, it'll only distribute to the donor the lesser of the two. Okay, that sounds negative, right? Why would anybody want a NIMCRUT? In a bad year, you get less. I want my 7% annuity come hell or high water. But the power is, and I left a few words off here that is very important. I wish I hadn't left them off. Makeup. If there's a shortfall where net income is less than the annuity, in subsequent years, you can make up the shortfall and distribute even more than the normal annuity, say 7%. So in an extreme situation, if there was no net income for 3 years, and then all of a sudden in the 4th year, you had a 40% gain at a 7% annuity, the 4th year, you can distribute 28%. So you can make up that shortfall and control the timing, not only of receipt of your cash, but more importantly, paying income taxes. Because when you receive the annuity, you have to pay income tax on the distribution. So
I mentioned one other thing here, Bill, that's also exceptionally important. And I always talk about, going into the bathtub and turning on the water and turning off the water. One of the things, and I talked about this NIMCRUT yesterday, this exact situation with a gentleman who is 39 years old, has built a very successful company, moving money between Brazil and America, similar to a Western Union concept. And he doesn't need the cash from his sale of his business. So we talked about the NIMCRUT, and he could have a distribution that continues to accrue. And by the time he turns 50, 55, when he wants to start taking his retirement income, then he's got this spigot that he can turn on and have it. So the one thing I do want to continue to mention is these strategies, although complicated, can be explained simplistically oftentimes, but more importantly, can be customized to the professionals, clients, as well as the charities. And I think that's something that we got to keep in mind. And that's what Bill and I specialize in, is helping charities and other professionals create charitable gifts from very complicated strategies that can be made simplistic if you have the right people involved. So
last thing I want to say on this is in the second bullet. Why did I set up the LLC? So far, we talked about a NIMCRUT, but we didn't explain why we interposed the LLC between the donor and the CRT. And that's due to a very unique concept in trust tax law. And it says you have the ability to select. I'm actually amazed at this. You as the donor have the ability to decide when you're going to pay taxes in this annuity, because what is the income being earned by the CRT? We have income being earned by the LLC in this case, right? They're holding assets. But when is the income earned by the CRT? Well, if it's 99% owned by the CRT, I guess in the same year. No, the CRT doesn't have income in the same year as the LLC, or at least 99%. There's no correlation. Instead of just passing it through like a normal account would do, you get to instead say, well, we'll define income for the CRT purposes as the distribution that is made by the LLC. If it doesn't make a distribution in a particular year, there is no income. That is powerful. That's amazing and unbelievable. We can define taxable income at the CRT level merely by turning the bathtub water on and off. Incredibly powerful. And Heath is going to get into that in a minute. I'm going to, Heath, do you want to interject yours now, and then we can come back and finish off the rest of the stuff later? Yeah, let's jump to yours because it ties in right here.
So I actually have a designation called Certified Specialist in Plan Giving.
You faded out a little bit there.
I'm sorry?
You faded out.
Sorry. I have a specialty designation called Certified Specialist in Plan Giving. I don't tell you that to brag. I tell you that because I love charitable planning on behalf of charities, but you need donors. And oftentimes we hear the objection, charity begins at home. I just don't give that much to charity. I don't buy it. And the reason I don't buy it is because most wealthy people have a substantial tax bill come due April 15th, September, October, depending on when their extensions are. What I like to tell people is this: if we can take your tax dollars that would have otherwise gone to the government and create benefits and social goodwill in the community, is that something that you'd be open to listening to? And most of the time people tell me yes. So what I want to talk about today is how to convert your clients' highly appreciated assets to cash without paying any tax. Usually I put the word legally on here. Compliance didn't love the legally part. So I always start with the question. Some of you have participated and seen me present this before. If you have, don't cheat, but raise your virtual hand, and then hopefully, Marianne, you can monitor that because I can't see it with the screen share on. But if you had 1 penny, and I used to say 1 copper penny, I know it's not exactly 100% copper anymore, but if you had 1 penny and you doubled it every 30 days, at the end of 30 days, how much
every day for 30 days.
Every day for 30 days, how much money would you have? one little penny that you step over on the street, if you had one of those doubled every day for 30 days, how much money would you have? Take yourself off mute. Just yell it out. I want to hear these answers.
$1 million.
Okay, great. Got $1 million? Do I have $2 million? Do I have 500,000? You can tell I was never a auctioneer in my previous life. All right, watch this. I didn't believe it the first time, the second time, the third time, or the 10th time that I used my calculator to figure it out, but it's right. One penny doubled every day for 30 days gives you $10,737,418. Let's change the question slightly. If you had one penny and you doubled it every day for 30 days, but on each day you had to pay a 20% tax on the growth, after 30 days, how much money would you have? $10,737,000, but now all of a sudden I've got to pay a 20% tax. If I had $1 million guess before, I had 5 million, 500,000, 2 million before, I got to have a different guess.
A lot less than 10 million.
Looks like. Say it again.
A lot less than 10 million.
That's a fair answer. Okay, no one's participating today. We're going to go ahead and get through.
Wait. Okay. I was going to try to be clever and say, well, it should only be 20% less than the other way around. But that's where the drama comes in.
Right, because remember something, you're not taking 20% of the entire amount, you're taking 20% each day. You do not have as much compounding.
So it doesn't have the ability to compound.
That is the difference between taxation and compounding. So what are we going to talk about today? We're going to talk about something that I call a tax-exempt trust. Section 664 of the code section, been around since 1969, as Bill mentioned before, commonly called, as Bill said before, charitable remainder trust or a wealth preservation trust. Okay? I call it a tax-exempt trust not to pull the wool over a donor's eye or a potential donor's eye or a client's eye. I call it because not everybody is charitably inclined, but people hate paying taxes. So if you can start to look at a solution for these people that benefits them from a tax situation, but also can help you create a gift on behalf of your charity, we all win. Here's the facts. $2 million piece of property, $2 million LLC, a $2 million C Corp, a $2 million portfolio of coins, Bitcoins, whatever it may be, with a cost basis of zero. Okay. Now, you don't typically see a cost basis of zero when it's talking about securities and or Bitcoin or something like that, but real estate can be depreciated down to zero. Could have started the business in your garage. So it's very possible that you could have a zero basis on a sale of an asset. And as Bill mentioned before, you've got long-term capital gains, federal, you've got state capital gains, state capital gains, and then you've got the 3.8% surtax. And if you're talking about real estate, you also have something called recapture of depreciation. You could be looking at 40% on the sale of the asset very quickly. Okay, so let's go ahead and sell the asset, pay the 40% tax, capital gains tax of $800,000, $2 million piece of property, you're left with $1.2 million. If you could go out and get 7% income on your assets on the remaining $2 million, you'd have about $884,000 of income. After 30 years, combined income, $2,520,000. 40% estate tax is of the $1.2 million that's left, $480,000. So let's look at the total math. $2,520,000 of total income over your lifetime. You've got $720,000 that goes to the kids, $2 million, less the $800,000, less the $480,000. You've got zero going to charity. You've got $1,280,000 tax bill. I just don't think the math looks good here. So what can we do? We could gift this asset to the tax-exempt trust, commonly called a charitable remainder trust. And as Bill said before, and as I mentioned, it's a tax-exempt trust. There is zero capital gains tax. One of the things that Bill nor I mentioned, and it's also something that comes along as a benefit to the CRT, but not the major benefit, is that you do get an income tax deduction for that initial transfer of the asset into the trust. So in this particular example, it created a $78,000 tax refund based on the income tax deduction. And so it's an added benefit we tell people.
That's a charitable deduction.
Charitable deduction, the refund was $78,600. Correct. In this particular example, because it's in a tax-exempt trust, we have $2 million left. We don't have to pay any capital gains. So if we're going out and achieving that same 7% income stream, it's $140,000 per year. Over the same 30-year life expectancy, $4.2 million. There is no estate tax because it is a tax-exempt trust. And one of the things that we did not mention fully yet, and I think it's exceptionally important because this is one of the major drawbacks of a CRT from a donor's perspective who is not charitably inclined. We know, based on our conversations here today, that the assets left in the CRT at the termination of the trust all go to charity. Bill mentioned the 10% rule, but it could have been a lot more than the 10% because the assets could have grown considerably over time. Client may die prematurely. There's a lot of reasons why it may be a lot more than 10% going to charity at the end of the termination of the trust. So the objection that we often get is, Heath, my kids want something. I want to leave them something, but I don't want to pay too much in tax now. What can we do? In this next example, we are going to take $400,000 one time. We are going to buy a life insurance policy worth $2 million so that the kids get the $2 million and the donors get the income deduction and the annuity payouts during their lifetime on the full $2 million asset. Okay. So in this particular example, we have $4,200,000 of income, less the $400,000 for the life insurance policy, plus the tax refund of $78,600, $3,878,600 in total income to the family during life. We've got the $2 million death benefit from the life insurance that's going to the children, so they get a full $2 million. In this particular example, the assets were only generating the 7%, did not eat into principal. The charity got the full $2 million at the end of the termination of the trust. And most importantly, here for this purposes today, there was zero tax paid by the client. Here's the side-by-side. If you just look at the math and don't have any idea what this CRT and this ILIT and all of this other stuff that Bill and I are talking about really means, the last line of this slide is the most important thing. The CRT, Charitable Remainder Trust, and the ILIT, an irrevocable life insurance trust combination, benefits the families and the charities to the tune of 2-to-1 versus selling the asset outright and pay the tax. I don't care if you're charitably inclined or not. I tell every person selling an appreciated asset, they at least have to explore this concept. It is not right for everybody. I'm not even going to suggest that, but it is at least a strategy, an option that these families owe it to themselves to explore. And most importantly, you wonderful nonprofits on this call today deserve for people to be exposed to this as well. If you don't have a knowledge of how a CRT and an ILIT and all this other fancy stuff works, or anything else that Bill and I have talked about or will talk about today, please reach out to us. That's what we're here for at the Community Foundation of the Valleys, is to be a conduit between you and donors. Okay? With that being said, I'm going to go ahead and put it back to Bill's slide unless there's any questions.
I have a question. For you.
Go ahead.
So you don't need to pull the slide back up, but you used the term ILIT at the end. At the beginning, you used return wealth replacement trust. Is there a difference between an ILIT? Say one more time what an ILIT stands for, and how does it or doesn't it differ from a wealth replacement trust?
Great question, Bill. An ILIT stands for an irrevocable life insurance trust. We utilize that vehicle to remove that $2 million, in this particular example, the $2 million life insurance policy from the taxable estate of the donor so that the full $2 million goes to the beneficiaries. Oftentimes, you will hear people use an ILIT as a wealth preservation trust as well. So those terms, in most cases, are synonymous. I'm glad you pointed it out to me. I didn't catch that. I should change that as well in the slides. But no, they are synonymous. And the one thing I also want to mention is, while Bill mentioned CRATs and CRUTs, those are the only two types of charitable trusts that can be created. Each one of them has a myriad of options that can be utilized to create. In this, for example, the NIMCRUT, that just happens to be a charitable remainder trust, but it happens to be a NIMCRUT, charitable remainder unit trust. So there are many ways to customize the length of the trust, the payout of the trust. I was on with one of my longest tenured clients, and originally we designed the trust, and people are going to shock when I say this, to pay out 13.8%. Okay, you can almost never receive a return of 13.8%. So what that tells you right away is that this client was eating into the corpus to achieve their lifestyle maintenance and retirement years and golden years, and that whatever's left will go to charity. It passed the test. They were older clients, but most people would laugh at that distribution. But in this particular example, they wanted to sell their apartment building they had bought 30 years ago. It was highly appreciated. They needed cash flow to fund their retirement years. And this payout was able to be created at a 13.8% of the dollar amount in the trust, not a return. And I think that's where a lot of people get hung up. So I've been bantering long enough. I'm happy to answer any questions. CRTs, as Bill said, are not simple, but Bill and I have the ability to make them simple for the donors and to explain complex strategies much easier for them to understand.
Hey, Lee, can you explain that again? The 13.8% of the amount in the trust versus the rate of return. Can you explain that a little better?
When you create the trust, and it has to be created on the onset of the transaction. So in this particular example, we created a trust that was going to last for my clients' lifetimes. In this particular example, the clients were already in their 70s. I could not do that for a 50-year-old. But to answer your question, Tom, specifically, the trust was created for the lifetime of my clients, both of them. At the second passing, that is when the charity will receive the money, at a 13.8% payout. What that means is for this apartment building was about $2 million. So we'll just use the same example. $2 million was the original contribution amount. 13.8%, approximately $270,000 year one. We did do a CRUT, a charitable remainder unit trust. What that means is it's 13.8% of the reappraised value of what's in the trust on 12/31 of each year. So for example, if the 2 million grew to 2.2, 13.8% of 2.2. If it drops to 1.8, then my clients are receiving 13.8% of 1.8. So
let's say at the end of the year, if things remain static, you have 2 million minus the 270, so you have 1.7 for simplicity's sake, 13.8 on that, then not the original 2 million.
That is correct.
Okay, I was going to say you're going to run out of money in a heck of a hurry. In other words,
Right.
If you design it as a CRUT, if you design it as a CRAT, it's going to be the $2 million that would initially gone in, and that's what the annuity payout's going to be on an annual basis. But you're correct. But to think about this for a moment, though, Tom, and I got a lot of charities on the phone on the call, but I want to be specific to this particular donor. This family had other charitable givings that they were already doing, so they were giving during their life. They wanted this apartment building to fund their golden years together. And that's why we took the payout. And that's why we were eating into principal, because they wanted the 10% gift approximately to be left at the termination of the trust. They wanted to eat into the principal during their lifetime because they were in charity during their life.
And what's the charitable deduction on day one?
On this particular example, it was approximately 10% of the $200,000 the way we designed it. $200,000 deduction.
Yeah, let me jump in on that. So we're always shooting to have the present value of the charitable, what goes to charity at 10% on day one. So you can design, there's two levers. One is the annuity rate. We just heard about 13% versus 7% a while back. And there's also the number of years or the life expectancy. So a combination, balancing between the number of years, could be a life term, and the annuity, you can massage. Let me do a better job. If you want a higher annuity every year, you reduce the term of years before the charity can receive it, and vice versa.
So let's say 200 grand the first year, for example. Year two, 200 grand again, or slightly less because of the payout.
It depends whether it's a unit trust or annuity trust. So that's a little bit different than the point I'm trying to make. What I'm trying to make is we start with the charity only getting 10% in present value terms on day one. So that's the present value of what the annuity. If there's $1 million in the trust on day one,
I got you.
We want to say the present value of what the charity is going to get is 10%. How do we get there? By increasing the annuity or decreasing the annuity, or increasing the number of years or decreasing the number of years. We massage it until it's exactly 10%.
I got you.
Okay, I want to say one more thing on before we move to the next topic on the CRTs. Should a donor advised fund, DAF, be a remainderment? That's a good question. I would say DAFs are a lot less relevant once you get to a CRT conversation. So it may not be the best thing to have a DAF as a charitable remainder. You could do it, but I don't think there's an advantage there. Okay, there's a few items left, and we're going to fly through these for several reasons. One is everybody should be getting a little ready to go home, and the other reason is they're not as popular. But it's good to know about them because somebody may ask, well, what's the difference? So for the professionals and the nonprofits, you at least need to know what these terms mean, so you can say, those really aren't that popular anymore. But at least you know the term and you can have an intelligent conversation. So we've been talking for a long time about charitable remainder trusts. There's a reciprocal to that called a charitable lead trust, CLT instead of CRT. So what does that mean? I call it a reciprocal. So how do you get to the reciprocal? The annuity goes to the charity for a term of years, and the remainder interest goes to your children. Okay, I reversed it, right? So instead of the charity getting it at the end, your kids get it at the end. And in the meantime, the annuity goes to the charity. It has to be for at least 10 years. So an example, I'm saying a 5% annuity for 10 years. The charity will get 50%. If you put $1 million in, the charity will get $500,000 over that 10-year period, and whatever's left will go to the kids. Well, the kids are going to get more than the remaining $500,000 because it was invested in the stock market and grew. So I started by saying these aren't as exciting as the others, and the number one reason is there is no avoidance of capital gains. So even if you transferred a highly appreciated asset to this trust and then sold it immediately after, you have to pay taxes on it. You've accomplished nothing. So that's why these aren't nearly as exciting as a charitable remainder trust. When could they be used? When do they even make sense? Why do they even exist? And that's for, we call it the leverage on the lifetime gift and estate exclusion. So I got to do a sidebar on that. We got a lot of accountants on the call, but we also have some people who may not know what I just said. Right now, there's about a $12 million lifetime exclusion from gift tax or estate tax on your wealth. So you can transfer 10 million while you're living. I'm sorry, 12 million while you're living, or 12 million at death and not pay any gift tax or estate tax. And it's cumulative. So you got to track it. So if you use it up while you're living, there's not much left for you when you die. That number is very generous today. 12 million is the highest it's ever been. I can remember, those of us who are older, 600,000. Wow, how things have changed. And that if the husband and wife are both living, it's 12 million for each. So we're talking 24 million. So, but if the person's wealthy enough to not want to pay that gift tax or the estate tax on the excess over 12 million, they can leverage that 12 million and make it much more powerful by using a charitable lead trust. Okay, because the kids are going to, in this example here, the kids are going to get it in 10 years, but it's going to grow in that 10-year period. And the gift tax, there's a gift tax return required on day one, and the gift tax is computed in a way that is considerably less than the actual funds that the kids are going to get. And so that's the gimmick. The gimmick is, yes, there's a gift to the kids. It's on day one of this 10-year period, and it's much, much less than what the kids are actually going to get. So that's the power.
I want to give one other real life example that might be appropriate for the charities on the phone. If you've got a donor that has committed, let's say, $10,000 for the next 10 years, you know that you're going to get $10,000 of each in the next 10 years. They only get a deduction of $10,000 each year that they give you the money. I'm using a real small example, but if they created a charitable lead trust, they could take the present value discount of that $100,000 today, but still only give you the next the $10,000 for each of the next 10 years.
So that's a second benefit.
Correct.
That's a great point, Heath. Let me just reinforce it. So that there is a second reason to do it. At least we have to get a little bit more complicated here. There's two types of charitable lead trusts: grantor and non-grantor. I don't want to spend time explaining the difference between each, but the benefit that Heath is talking about only applies to a grantor CLT. And yes, they also get a nice charitable deduction in year one for the present value of that annuity that's going to charity. And they lump it. So the game is, okay, today I have a huge income event, right? Same thing. I just sold my business. I'm going to have a $10 million gain. Should I consider, I'd much rather do the CRT, but does a CLT also make sense? And the answer is yes, because you get a huge charitable deduction in the first year that you transfer funds to the trust after you sold the real estate. A little different plan. So yeah, it's good, but not as good as the CRT. Okay, and the next slide talks about a non-grantor CLT. Again, I'm not even going to go into it. What's on the next slide after that, Heath? There we go, bequest. Okay, so everybody should know about bequest, right? You can name a charity in your will or your living trust, such that when you pass, the charity gets those funds, gets those assets, whatever. Let's not forget about bequests. I'm on the board of a nonprofit where we're pushing very hard on bequests. And the reason is we have a long-term vision. We want people to contribute funds at their death, and they often say that they don't know if they're going to need the money or not. They can't afford to give to charity now because they might need to live off this money. Well, if it only goes to charity when you no longer need the money, then it's something that might be attractive to a person not interested in tax benefits, who's strictly charitably motivated, and they have the peace of mind of knowing that they don't have to give to the charity until they pass. There are no tax benefits in that situation, no income tax benefits, but let's go back to the wealthy person who has more than a $12 million estate. Now, in addition, if any money left at death, if your estate is worth more than 12 million, you will be saving estate tax because the charitable gift at death is deductible from your estate tax. But how many people have a $12 million estate? Well, probably a lot of wealthy ones do, but it doesn't apply as often. Could I go to the next slide? So we talked about a bequest, and so I'm thinking, gee, is there any way to turn a bequest into something that has an income tax benefit? And one thing I thought of is at the bottom of the slide, and that is, instead of bequesting cash you bequest an interest in your retirement plan or your IRA. So if you have a $5 million IRA and you're going to pull X amount out of it for the rest of your life, and at your death, you're planning to leave the balance to your children, well, maybe it's smart to leave some of that to charity by naming the charity as a beneficiary of your retirement plan, in addition to your kids. Because to the extent you name the charity, whereas there's no deduction for a charitable deduction, the income that would have otherwise been distributed to your children would be subject to income tax at the level of the children. So there are potentially substantial income tax considerations to whoever receives the distribution. So if a charity is receiving the distribution, then you avoid the income tax. It's a more powerful gift than leaving it to your kids. And that way you get a tax benefit out of the bequest. Next slide. Okay, this is the last one, thank God. But it's something to think about. And I'm intrigued that the California Community Foundation will let us do this. If you can contribute your home to a DAF. And why would you do that? Well, let's say you're 75 years old, you're single, and you're very fond of charities, and you want to be charitably motivated, and you decide after some discussion with your advisors to leave your home to charity, to the DAF. And then after your passing, the DAF has to have instructions as to how you want to spend it after you're gone. But they'll disperse it for you over a period of time. And in the meantime, what did you get? Why would you do this? And by the way, this is called a life estate. You are given the right to live in your home for the rest of your life. So you have the right to live there, but you gave it away to charity, let's say 10 years before you died. The charity owns it. It's an asset of the charity. And therefore, because you gave it to the charity 10 years before you died, there's a big charitable deduction. Yes, it's not as much as you didn't have the right to live in it. That reduces the charitable deduction, but it's still a big charitable deduction for the value of your home. So if you can use that income tax deduction, and not everybody's going to, but if you can use that income tax deduction, then there's a reason to do it. You get the deduction 10 years before you pass. Remember, if you can't use it all the first year, it carries over for up to 5 more years. And so over a period of 6 years, you can get substantial charitable deductions until you pass. And yet you have the right to live there for the rest of your life. This also can apply to a second home, by the way, that you want to have the right to use as a second home. But I think the home example is the easiest one. You avoid the capital gain on the sale of the home. Of course, you probably would have avoided that anyway if you left it at death because of the step up in basis rule. So that may not be that exciting, but you do get the charitable benefit. And I'm just impressed that the California Community Foundation will accept that asset, your home, even though you're going to live it in for the rest of your life. So that's kind of impressive that they will deal with that type of asset when they can't just turn around and sell it. Okay, so that's my last item. Should we open it up to questions? Any questions? I don't see any hands going up. Michael has a question. Is your mic on?
Hi, can you hear me?
Yes.
Go ahead, Michael.
This is actually a question for Marianne, or one of you.
Marianne, turn on your mic, Marianne.
But I'm curious if the community foundation, your community foundation, has a policy on DAFs about payout. In other words, let's say I set one up, put in $1 million, and forgetting what the potential new law may be, assuming that doesn't pass. Do you have a policy if I just don't do anything for a few years? Do you have a policy of a required me advising on donations, or what happens?
Michael, I think are you asking, is there a minimum requirement that needs to be paid out from the DAFs at the Community Foundation of the Valleys?
From a policy standpoint, not from a tax standpoint.
Heath, you want to take that one? Mary Ann can answer, but maybe Heath might be feel more comfortable.
I'm not certain we do, Bill. I mean, I don't recall that conversation, do we?
No, in fact, just the opposite. Again, the way we benefit from it directly is by earning a 2% of the asset fee. And so if you don't disperse any of that money for 10 years or 20 years, we continue to earn the 2% on whatever it grows to over that period of time. So we, from a policy point of view, we're just as happy if you don't distribute it. Obviously, from a nonprofit point of view, we'd like to encourage our donors to be very generous with all the nonprofits in the community and disperse as much as they can. But from a policy point of view, we're indifferent.
Okay.
Before anybody else jumps off, I will be the one that my company is the one that provides the continuing education. I'm going to hit enter. If you look in the chat, that is my email address. If you would like credit, whether you're an attorney or a CPA, email me offline. Email me obviously the correct name on the on your license number and email address. Obviously, I'll get off the email and best mailing address, and I will go ahead and get those certificates out to you probably early next week.
I too have an announcement before too many people jump off. Because I knew this subject was a little bit complicated, I prepared a chart of all the items we've talked about today. I call it my inventory of tax planning ideas and the pros and cons of each one. So a nice 2-page handout. I encourage everybody to keep it handy. Whenever you're having a charitable deduction conversation, whether you're the nonprofit talking to a donor or you're a professional advisor, here's your little cheat sheet, 2-page summary of everything we said today. How am I going to make that available? I've asked my assistant to email it to everyone already. So when you sign off, look at your emails, see if you have an email from Brooke with an attachment of an Excel file. And if that didn't happen already, I have everybody's email. I will take the time to email this to all of you in the next 24 hours.
Bill?
And Bill, related to that, I just want to mention somebody else who had to jump off early asked if we could send out the slides. So maybe both the handout you have and the slides could be sent to everybody that signed up for the call today. I think that would be really awesome.
Yeah, the 2-page summary is nice. It's just a memory jogger and easy to keep handy.
I think Brooke included that on the invite as well.
Okay, good. Yeah,
I think I
Maybe we
saw,
can send, we can send another email
the
out.
2-page handout. I didn't see the slides, though.
Yeah.
No,
So
we need to add the slides now. We're happy to do that.
If you did, that would be awesome. Yeah. So
I want to be respectful of your time. Obviously, we talked about 6 o'clock. We got a few more minutes left. Are there any other further questions? Mary Ann, as the head of as the president of the California Foundation of the Valleys, or Bill or me?
I do see 7 chats. A lot of them just saying thank you.
mhm.
I don't see any questions in the chat that haven't been answered already.
Is Congress going to change the lifetime gift tax exemption?
The good news is they haven't yet. And Biden was planning on reducing the lifetime exemption. But about 45 days ago, he changed his mind in an effort to try and pass his Build Back Better and did not go down that path to reduce the exemption. So even though he was promising it 6 months ago, wealthy people can rest again that the $12 million is not going to be reduced to something less, and therefore estate taxes are not going to go up, and that we still have a lot of the tax planning techniques we thought we had.
One thing I do want to mention, though, in addition to everything that Bill just said, under the current law, though, the high exemption amount that Bill is talking about is set to sunset on 12/31 of 25. So if there is nothing and it is not made into permanent law, that will be 1/1 of 26. You'll be back to something a lot less than the 12 million. So
right, and then that gets us all to speculate do we have a Republican or a Democrat president at the time, and what's going to be the current attitude on either renewing the current exemption or increasing it, decreasing it. Yeah, but yes, it's a whole new ball game after 2025. Something has to be done.
That's a question. Holly just posed a question that I'm going to turn over to Mary Ann. How would you suggest nonprofits encourage people to give from their DAFs? I think that's a great question for Mary Ann.
Yeah, it is. And I do want to say that to answer Michael's question, it's related. We do encourage those that have invested with us to actually donate to charities, because that's why we're here. We really want to support the nonprofits, and having run a nonprofit for a long time that was privately funded, just realized, how much we really needed a broader generosity, if you will, in the valleys for charitable giving. And often the charitable giving goes outside the valleys to downtown LA or the West Side or abroad or wherever, and kind of making people aware that our charities are doing great work. They're serving needs that affect our local communities where we live and work and so on, and that they need to be supported at a good level so they can continue that work. So we do encourage our donors to give that. And I think it is something of, in terms of encouraging, as Holly said, encouraging people to give from their donor advised funds. It's kind of a matter of, sometimes it's pulling at people's heartstrings about the important work that you're doing and how they can support that work through their donor advised fund. And to continue to supplement it, to not only give once, but, to give out some, maybe resupplement so it continues to earn interest, and then give out some more. And, we may look at that. I know some foundations require people to make an annual donation or whatever, so we may consider that. But it is a matter of kind of staying in front of donors and communicating your stories. Because a lot of times charitable giving is not so much about what's in people's heads as much as it's about what's in people's hearts and what pulls on their heartstrings to give to causes that are important to them. And it's very interesting how people are all over the map in terms of what is really important. Sometimes it's a matter of, I remember hearing a very prominent business person at a meeting in downtown LA who was really advocating for the work for the unhoused. And I thought, well, that's so interesting. I wonder why. He's a very wealthy person, very prominent. So it turns out that he had a brother who was schizophrenic, who died on the streets of Seattle as an unhoused person. And so he had a personal passion, for that particular cause. And of course, there are many other causes. Somebody that's disabled in one's family, or and you want to support whatever that cause is that's helping people like your family member. So that's part of the work of the nonprofits. But also, I should mention that the Community Foundation, we have spent a lot of time, even recently, in touch with various nonprofits in the Valley, listening to what they're doing and the good work they're performing, so that we can then advocate on their behalf to donors about where to give charitably, depending upon the particular causes that are of interest to them. So,
yeah, let me add on to that, Marianne. The only difference between a donor who has a DAF and one who doesn't have a DAF is that the donors already parked the money ready to be distributed if it's in the DAF. So it's actually easier. You don't have to persuade the person to part with the money. They've already parted with the money. It's sitting there trying to find a worthy cause. And so if you, the nonprofit, discover somebody has a DAF, you're one step closer to getting the funds because it's already waiting to be distributed.
Yeah, very good point.
If I can make one other comment.
Sure.
Bill, when he put up the advantages of a DAF versus a private foundation, there's one I would add, and that is a private foundation, the tax return is a public document. So a gift to the donor advised fund is not that information is not public information.
Very important. Very important.
Very true. And there are donors that prefer to be anonymous in their giving, and that's one of the ways that we can, as a community foundation, they may say, I'd like to really give to after school programs, okay, or to food banks or whatever it is that they choose. But for whatever reason, they prefer to be anonymous, and we can facilitate that. Or if they like to be mentioned, we can certainly accommodate that as well. So I think it's a good point.
Yeah, let me chime in on that too. Both ways, you can be anonymous, but if you go the DAF route and don't want to be anonymous, you can name your DAF. My last name's Wolf. I can have the Wolf Family Foundation, and in fact, I do. One of the largest contributors to the Community Foundation of the Valleys is the Wolf Family Foundation. It's just my little carve out on the DAF at the Community Foundation. So that works too.
Right. Yeah.
Real quickly, I mentioned it before, but I want to offer it again. If you have complex donor questions or situations where you think Bill or me could be of assistance to you as a resource from the Community Foundation of the Valleys, please reach out to us. And we'd be happy to help you if we can. Thank you all for attending. I hope the information was beneficial. I did see Peggy Matsuda. Peggy is an advisory board member to the Community Foundation of the Valleys and goes above and beyond to assist us. Marianne puts in an unbelievable amount of time and has done an amazing job spearheading this for the last year. Before that, for many, many years, Tamara Gurney, who I saw on the screen as well, but was driving, so I don't want her popping in, led this organization for about the last 7 or 8 years. I might be wrong on that, but it was a long time and did a fabulous job. So I just wanted to point out, my fellow board members, we are here to be a conduit between you and the donors here in the Santa Clarita and San Fernando Valleys, and I thank you for your time.